Good morning and welcome to the Monday Market Update. I'm Nash Paradise, joined as always by Mr. Andrew Cady. Andrew, how you doing today, sir?
I am doing amazing. It's a great weekend, great time with family, no complaints.
Hey, love that. I was a dance dad this weekend, which meant 19 hours at dance competitions and recitals and 7 outfits and all the things. And I'm like, all right, well, that's big. I wasn't ready for that. I mean, my baby girl's 8, but she loves it, and so hey, we do whatever our kids want to do, wherever they're happy. That's where we show up.
Yeah, your dance is my volleyball. We're about to start into volleyball season, and it will be busy, but we love it.
We do what we love, and that's why we're here. Is because we love econ. Well, no, we don't. But we do love helping people with mortgages. And so understanding what's going on in the market, what's happened last week, what's going to happen this week, having the tools to equip you to share this information. This is not something that we're doing for our help. We already know this stuff. We are sharing it so it can be shared. So it can be shared with more people. So that buyer who's on the fence, that person reading the news articles, getting bad information, that you, because you've heard this from us, now you have better tools to equip them to make the best decisions for their family. So let's break it down and see what happened and, see where we're going here. So pretty mid week last week, usually when you have a, 5 bips drop to the interest, like it looks more severe than it is. We're a little narrow on this graph,
right?
But it's really more of a matter of, we got that slow is smooth is fast, not real volatile. We got a good change and then sat in it. Anything else you'd add to what we saw last week?
No, pretty quiet week. We talked, about Thursday being the day that really could be market moving. And that was kind of the day that it moved a little bit in our direction. And so I think it's worthy of noting that it was a great week. Not a ton better, but I think we set the stage that as long as this ceasefire can come back together, we might be in good shape.
Yeah, 100% agree. It was smooth at the end of the week. The end of the week was the big risk. Things could have gone poorly at the end of the week. We had so much data coming in, and with, a new Fed and markets and analysts trying to figure out what's going on with things, we were set up for some potential failure. So it looks totally smooth on this chart because it was totally smooth. And let's get into what actually happened last week. As we look through the econ data, Thursday was the day we had everything.
Yep.
Most people watching don't really care about all this stuff, and that's fine. I don't blame you. So if I'm summarizing what happened last week, we had PCE. This is the Fed's favorite inflation tool. And I did see some headlines, at news outlets, hey, inflation is up to 4.1%. Well, that's exactly where it was forecasted. That was a reasonable, figure to hit for, PCE on, a year-over-year scale. And markets didn't really seem to care. It was aligned with expectations. Had we missed high, that could have been pretty bad. Core came in at 3.4%. Cool. Like everything is about where we needed it. Jobless claims were flat. Continued claims were flat. Yeah. Everything else pretty flat, right on the money. Anything that you'd add to last week's data?
No, I think the markets were pleasantly surprised that we didn't miss the expectations. And rewarded us accordingly for it. I think it was a very clean, easy week. It could have been a bad week. There's a lot of things that could have tripped us up, and overall, we skated through pretty well.
Yeah, and if you've been with us for a while, you know that there are two main factors in econ data: employment and inflation. And one is usually more important than the other. One sometimes one looks good and the other is rough, and so that's where all eyes are. Right now, all eyes are on inflation. As we are transitioning out of this war in the Middle East, oil prices have been taking a lot of focus, and whether it's real or transitory, inflation is the big number. Even after Warsh's statements, the Fed target to get inflation under 3%. That's where everyone's going to be looking. Jobs just need to hold the line, and they have been for a while. So PCE had that focus, and like I said, looked pretty good. So it's hard to say inflation going up 4.1% looks pretty good, but I think the markets are giving a lot of leniency to how much of that is impacted by global energy prices over the last few months.
I totally agree. I think the markets are understanding that if this conflict is coming to an end, then we should see things better here, not necessarily continue to. I think markets took it with a bit of just lightheartedness.
Go. Let's see what we got going on this week. We got a half week, 3.5 day week. I don't know. I call it half week.
It's a short one. It's gonna be a short, volatile week.
It is, and I'm not going to be here all week. I'll be voluntolding at kids camp. Apparently, I'm the 6th grade boys leader. I found out last week, which is fun, and then I get to miss all the meetings up until then. But I'm still going to be in charge of a pack of rabid, feral 12-year-old boys. So as long as no one breaks anything and there's not too much blood, we're fine. But I will not be watching any kind of bloodbath on Thursday. I'm going to go ahead and throw that out into the universe. And I'm going to claim that it's going to be just fine. And normally the first Friday of the month is jobs report.
Yeah.
It's NFP, non-farm payrolls, unemployment rates. And, we talked last month about the non-farm payroll number being pretty low on new jobs added. And, what could that do to markets if we missed even lower? Well, thankfully, it was pretty okay. This one, we're projected 110,000. That's a level that people are going to like. We can be a little high or a little low. It's not going to move the needle. Unemployment rate should stay at about 4.3%. I think we're set up for another flat jobs report, especially after ADP and, the weekly stuff last week. Jobs report should be just fine. Anything you're concerned with?
Not really. I mean, I think, obviously last week was the focus was inflation. This week, the focus is jobs. We skirted by last week. I think on a technical level, we're definitely at a spot where we could break through some floors of support. If we get good data out of this, we could probably see a little retraction of 25 basis points or so if we get bad data out. It's going to be a short week, and there's always, increased trading on these short weeks. We got really no news today at all. It's going to be, all technical driven today. Tomorrow, JOLTS report could move markets. That's the job openings and labor turnover. That could move markets. And then it's on to really ADP on Wednesday. But the markets haven't really cared much about ADP lately at all. It's going to be Thursday's BLS jobs report and see where that comes in at. I do agree. At 110,000, we've got room to go up or down a little bit. Although I think it's worthy of noting the last jobs report, we had some positive revisions to the previous jobs reports. I think it was 93,000 additional jobs added. So it's definitely something to keep an eye on as we head into Thursday with markets being closed Friday. It's going to be a very short trading week this week.
Yeah, short trading week can mean high volatility, but it can also mean, some margin. If things are better, like you're not going to see there has been so much activity over the weekend. It seems like, wars start at Friday at 4:00, and then, Monday morning, ceasefire starts. Like it is literally a weekend war right now. I'm like, this is so ridiculous because it is, like markets are closed. We're bombing each other. And well, hey, hold on. We care about the market. So we're going to go ceasefire it up again. It's been funny. And like the markets have kind of come to expect it, and it's stopped any kind of overreacting.
I think you figured out their strategy. Like 4 p.m. on Friday, drop the bombs. Now about 10 p.m. on Sunday night. Nah. We're gonna stop again. We're gonna be friends.
Yeah, get right before. Hey, we gotta close this loop before U.S. markets open. I'm like, yo, this has been consistent, but we have a longer weekend. Short Thursday even. So I think if it's gonna get better, it's not gonna get better by as much as it should, but that could bleed into that following week, and it could be beneficial. So I'm anticipating good things. I feel like jobs are going to be fine. They're going to be strong enough, but not too terribly strong. And that should keep everything fairly flat. I would like to not be surprised while I'm not in a place to take action. So maybe I'm just forecasting that out in the universe. But let's move on to Fed stuff. So this chart looks a lot tighter than it did last time. This is our Fed funds aggregator. Where are rates moving? And I want to bring up last week's Fed funds aggregator because last week looked very, very different. That was solidly in the 4.25 range for all of 2027, basically, even at the end of 2026, forecasting a second rate hike. But now, just 1 week later, all the expectations are not needing a second hike, but just going to this first one. What do you make of this, Andrew?
I think we're still in for the first rate hike. It's how quickly things can change. Oil coming right back down. That was, I think, one of the market's biggest fears is, okay, so let's open the Strait of Hormuz. Is it going to take 6 months for the price of oil to come down? And we saw it drop down to $68 at one point, or 67 last week. That's pre-conflict pricing. And I think the markets are rewarding that, saying, all right, I do think we see a rate hike potentially at next meeting, probably more like September, October meeting. But I do think second rate hike, especially with Warsh at the helm, I think he may be a little bit more patient in this than Powell would have been. So I think the markets are probably predicting this right. I think it's an amazing shift. And we were, talked about it last week, it's a little 6% chance of a third rate hike. That's totally off the table. Barely less than a 50% chance now of a second rate hike.
Yeah, I think things keep moving in the direction they're moving right now. We've talked about this before. The fun thing about this aggregator is changes week over week and really identifying where is the needle moving. And right now the needle is moving to less movement out of the Fed. I would agree with you. I think with Warsh, and he's speaking this week on Wednesday. I think he's got a press conference. It'd be interesting to see if anyone reacts to that as they reacted to his last one pretty severely. I feel like he's the type of Fed chair that will push for slower movements. So even though the aggregator is showing the likelihood of an increase at the September meeting, I'm actually thinking that like October is going to be, I think these will continue to move down. I think we'll start to see some, assuming we get in and out of this conflict, I feel like the Fed is going to want to see what happens to markets as we exit the conflict before getting too aggressive with making changes. Seeing oil drop below 70 a barrel signaled that we can move quickly on that, to your point. And if that's happening and inflation is staying pretty steady, if we can get a little clip on it, then I think that hike doesn't come until, fourth quarter. And, we'll see. But it's nice anytime you're moving from a potential of solid, like we are 97% into a second hike by mid 2027, and now that has wound way down. So things are moving in the direction that we want it to move in. One hike's not bad. Multiple hikes in the future will scare the markets a little bit. So this is good news. All right, let's get into where mortgage rates are. Oh man, I feel like this is just our life. All this up and down, up and down, up and down. Ever since we got into higher oil prices, now I'm starting to feel a little jealous of all that time we spent around that 6.2% range. Like, oh, can we just drop below? And oh no, we're almost 6.4. And now we've been playing for the last couple months in these upper mid sixes, but it's fine. It's all fine. Everything we've had from, October of last year till now, it's fine. People aren't making different decisions at 6.5 than they were at 6.35.
No,
but I am seeing prices come down. I'm seeing like home prices more in the last week or two. I ran a deal on Sunday. It was tax assessed at $597,000 last year, and then tax assessed at $530,000 this year, and now it's listed for $450,000. Like
Yeah.
it's, it's newer construction, and new construction was always one of those higher risk factors. But things are settling down a little bit on values, and I feel like that's going to end up being more indicative of buyers jumping into the market than rates, dipping below 6.4% eventually. I just don't feel like these rates have the potential to really move things like everything else does. What do you think?
I 100% agree. I think if we saw rates drop below 6%, it would absolutely, shock, jumpstart the market. Great. But dropping to a 6.25, you'll have some more buyers that enter in, but home prices settling down is what has needed to happen. Let's just be
Mm-hmm.
honest. Like at the end of the day, we all want, if us homeowners, I'm a homeowner, I want my equity to stay there forever. However, we also need to be realistic that my home doubled in value in a matter of 7 years or 6 years. That's not realistic. It comes down 40% off of where, or it comes down 20% off of where it was, still in a really good spot on it. And most people are in that boat if you bought in the 2020, 2021 range. But I'm definitely seeing the same thing, especially in like Jacksonville market. It's a really, really, really challenged market. It's and one chart, the most challenged market in the country right now. We're seeing the same thing. Looking at, assessed value on a property tax bill that's $50,000, $80,000 higher than the sale price. You're seeing $100,000 price reductions on $600,000 homes, and it's good. It's what we need in order to kickstart this market back in the right direction.
All right, so let me ask you a difficult question because I'm also a coach, and I spent an hour before this call coaching LOs, so I've still got my coach hat on. This is my coach hat. So I'm going to force you to answer a difficult question here that I'd asked any of my coaching students. So you see this, this is true. How do you avoid conveying this? Or let me re-ask it. How do you answer the question? Well, Andrew, they're dropping. So why would I want to buy now when they're on the way down? Should I wait for them to keep dropping? I feel like they'll go further.
Because it's time in the market. You cannot time the market. If everyone would wait for the bottom, there would be no bottom to it. And the thing is you're never going to time the bottom of the market. It's time in the market. If you would have bought a home at the absolute peak in 2006, 2007, before the housing bubble crash, and you owned that home 10 years later, you would have done very, very well. And so it's not about timing the market. It's about spending time in the market. And if home values are settling down, that does not mean that tomorrow interest rates don't drop and home values start to rise again. You just can't time it. If anybody was that good, all we would be doing is trading bonds, and we would not be in mortgages. I tell you that much.
Yeah, no, you're 100%. Don't miss that takeaway. It's time in the market, not timing the market. I used to always tell people back in the day, you never buy stock for the absolute cheapest it's ever been. You buy it for where it's going to be in the future. And I think this market and going forward, looking at the next couple of years, it does present this challenging objection to overcome, which is that a lot of people, the internet is full of a lot of people making a lot of claims. There are a lot of very loud people who've been saying for years, the market's, it is a bubble. Bubble's going to burst. And when you start seeing signs of dropping values, they're so edified. Oh yeah, here it comes, man. I've been telling you, watch what I've been saying. It's going to keep going down. Like the bubble is bursting. Look at delinquency rates. Look at consumer, credit debt. Like this is all the highest it's going to be. Like there are some indicators that show things are going down and will continue to go down in some markets, and that will continue to happen. Yeah, you go from being a Facebook market analyst to a home buyer, and you think you know more about where things are going, you're going to run into some trouble, and you're going to be wrong. Like we're all wrong. I know more about this than you, random stranger on Facebook, and I can't time the bottom of the market. Like there's no way. But what I can do is figure out where is their value. And there's a book, The Gap and the Gain. It talks about periodically like looking back and seeing where you've come from, seeing where these wins are, and having a sense of accomplishment for what has taken place. And I've got buyers, I'm trying to tell them, look back a year ago, this house has come down $100,000 from where it was last year. Like that's the win. Yeah, your payment's up there because you got a 6.5 interest rate, but this has come down 100 grand. It's a 3,100 square foot house. Like it can only go down so far. They're building materials, things, and thankfully this Texas market, land value has never always been that high. Like you can get down to the nitty gritty of like, what would it cost me to build this sticks up? And we're seeing that in some of our markets where it would cost you more to build this house than what you can pay for it, because that's just the cost of materials now. And just trying to find ways to connect with people and letting them know, like, we need to see where these wins are and use these wins now. Could that be lower in the winter market? Sure, absolutely. But if rates drop a little bit more and you got more buyers to compete with, what's going to happen then as things turn around and shift? Like, where's it going to be in 9 months, 12 months, 8? No one knows for sure. Can
Right.
you be patient, wait and try to time it? Maybe. Okay.
Yeah, so that 500 that $600,000 house, it's 500,000 now. It's come down $100,000. Could it come down another 20,000? Maybe. Could be possible. But you could also find yourself in a scenario where it doesn't. And okay, let's say it does. Let's say you buy it for the 500 and the value drops to 480 before it starts to climb again. A standard 3% appreciation puts you back $15,000 of your 20,000 in 1 year. And that's just a standard low 3% appreciation. Keep in mind, the housing market going back 80 years has only had 6 years where the housing market lost value. And 5 of those 6 was the housing bubble. 1990 was the only other year that home values declined by 1% as a nationwide average. Housing is still a very strong investment. Yes, we've seen wild appreciation, but we've also seen wages go up. We've seen a lot of things that have gone up with it. So I don't think this is a bubble. I do think there's markets that are settling down and will probably continue to settle down.
Yeah, I think we got a couple of years of stagflation, if you want to call it that. I think things are going to be pretty even keeled as we get away from some of those golden handcuffs. People get relocated. People are downsizing. There's fewer sub 3% interest rates out there every single day. People are refinancing, consolidating credit card debt, because as we've seen in our econ data, consumer spending was not impacted by inflation, was not impacted by all those prices going up because of oil and energy. People are still spending money. It's just going on credit cards. Like, that's going to point towards the next couple of years, things that are designed that will keep the housing market stable, if not declining slightly. And ultimately, that kind of balance is healthy. That balance has opportunity for buyers. Probably not the greatest market to sell in, but if you bought 5-6 years ago, like, yeah, you timed your sale a little poorly, but okay, you're either going to wait another 4 or 5 years for more balance, or you're going to take your win on the buy side. Like, you can't have both ways. You're not going to sell for top dollar and buy for a great discount. But if you are in the market, like Andrew said, it's time in the market, not timing the market. You're getting both sides of it. You got to sell for less, but you're buying for less. Like, it's just all compartmentalization. And as experts, mortgage brokers, we need to make sure we're understanding our buyers, understanding our real estate agents, and helping everyone convey the information that can put them in the best position to make financial decisions for their future.
I could not agree. No better way to end it right there, buddy.
All right, man. I was hoping you'd drop another dime on me, but I love stealing your quote there. That's a good one. I know Joe's going to use that in the chat. It's awesome. Thank you for the gold. I will be back next week. Andrew's going to be on vacation. We'll chat about what's going on. We'll recap what we have on this short week, and we'll keep making plans for the future. Appreciate you guys.
Peace out, guys.
Take care.